Good morning, traders and investors. Roger Scott here, senior strategist for Wealth Press. Today is Wednesday. It's May 3rd. The summer is almost here. It's about 7:52 in the morning. The market's going to gear up to open up in about an hour and 38 minutes. Now, the Nasdaq is up about 38 points. The Dow's up 44 points. Now, this is very mild, and I wouldn't really read too much into this, especially in light of the fact that today we're going to have a major report. And that's going to be the FOMC announcement and the Fed chair conference. Now, keep in mind, the odds of us raising, not us, but the Fed raising rates a quarter of a basis point is about 90% right now. It's pretty much baked into the market. But what the Fed chairman is going to say, that's going to be the wild card here. So we got to be really mindful of the long bond, and not just the long bond, also the short-term bond, which is actually moving higher. Let's see how SHY is looking. Now, what you want to look at, the reaction of the bond market at this SHY while the Fed is speaking. This is very dynamic because it's only a 1 to 2 year, not a 10-year bond. So, again, you got to watch out really carefully because it's building a descending triangle. And if it breaks down, that means interest rates are going higher. If it breaks lower, that means interest rates are going higher. If it breaks higher, it means interest rates are going lower. There's an inverse relationship. So keep your eye on this. Again, I'll repeat this. If this breaks down, that means interest rates are going higher. If this breaks higher, that means interest rates are going lower. So there's an inverse relationship between SHY and the SPY. Now, a few other things I want to talk to you guys about it's very important. Now, I mentioned this about 2 days ago. I mentioned that the highs. Now, this is algos right here trying to squeeze us out just like they've done before. Look at that. Looks like a breakout. And then look at what happens. It kind of sits there, and then it comes back down. Kind of sits there, and then it comes down. So I'm looking for momentum levels to start declining, not increasing, because the majority of big cap earnings are over. And also, this is something else I wanted to show you. The Russell 2000 is overdone to the downside. It's not breaking up. The fact that the Russell is not contributing to this is telling me small caps are not ready to break out. And if small caps are not ready to break out, that means large caps are not ready to break out. And that's one of the reasons why we're seeing this divergence right here. This to me looks like a top, and it looks like we're going to be going down. Also, if you look at the Dow Jones, you will see that we've been really consolidating for the last, let's see here, 6 months, or no, what am I saying? We're not in January, we're in March, we're in May already. Days just get away from me. We're already in 5, and this is 11. So we're talking about 6 months of consolidation without any directional bias, which is very similar to what we're seeing right here from the bond market. Not a lot of directional bias, not a lot of movement, just a lot of choppiness. If that's the case, that's more than likely going to continue moving in that direction. So we got to be really cautious right now. Let's talk about all the news, and we'll talk about what we need to watch out for today. But honestly, I think the market's going to be pretty subdued till midday when we have the FOMC. And when we have the FOMC, it's best not to have a lot of positions holding because the market's going to be very fragile. Usually a lot of volatility, but not a lot of directional bias. So 3 major U.S. benchmark indices finished the regular session lower. A mere fear about the health of the U.S. banking sector weighed on sentiment ahead of the Federal Reserve interest rate decisions. In Tuesday's trading session, energy stocks were the biggest drag on the market as the price of crude oil dropped over 5% to a 5-week low on worries about a potential U.S. debt default and weak economic data. Financial stocks also weighted on the broader market amidst the rescue of the First Republic Bank from JP Morgan. That'll be very interesting. And data on Tuesday showed that jobs opening fell to a 23-month low, which means there's not a lot of job openings, which means the market is getting tighter again. If the market's getting tighter, that gives the Fed a license to play games, as they often do. At least Powell to posture that he's going to be potentially increasing rates because the job market's tight. But the Fed did get some welcome news. The numbers of job openings fell. Third straight large decline. Lowest level since March of 2021, so there's not a lot of job openings. Another major upside for the market, but again, you need continued catalyst. You can't just rely on this long term. The market's down 1.4% on earnings on EPS. They were expecting negative 5.1. So last quarter, it started down really bad and it kept going lower. In this case, it started down negative 5 and now it's only down 1.4, which is telling me that earnings estimates have been beaten down to death, and I mean to death. Today, all eyes are focused on the U.S. Federal Reserve monetary policy. U.S. futures have priced in an 85.7% chance of a Fed raise its Fed fund rate by 0.25, bringing us to about 5 to 5.25, highest level in nearly 16 years. I can't imagine it's been that long since rates were that high. And again, we have to watch out for Squirrely Powell's statement on the future of the policy. In Europe is too focused on U.S. data. And gains in food and beverage stocks led the market higher. They're doing okay right now. Stocks to watch, AMD down 5%. The personal computer space is not getting great. Starbucks down 4%. LiveNet up 9%. Sprout Social down 17%. Western Union up 3%. And boy, oh boy, today you've got Qualcomm, CVS, Estee Lauder, Public Storage, Heinz. I'm just going by stocks I'm familiar. Barrick Gold, Corteva. A lot of stocks are breaking out with earnings, so you got to be really careful. Looking at momentum levels, and this is something we need to pay attention to. Energy now is at 0. Now, what usually happens when momentum levels decline? You know the answer to this question. Look at this. Energy is really overdone to the downside, so I'm actually expecting energy to start moving higher. I don't think there's much more downside in the energy sector, and energy is still actually holding up pretty good. Other sectors that are not looking all that great, you've got basic materials, information technology. Where's basic materials? Basic materials. There's materials. They're all coming down. So there could be a little more downside in the short term. A lot of this is turning red. Notice there's nothing really high up there. But look at energy on the 50-day line. Really, really weak. It looks like it's got just a little bit more to go. But energy looks to me like it's going to be on a 200-day. Let's look at it on a 200-day. But energy looks like it's bottoming out. It just doesn't have a lot of upside, right? I mean, a lot of downside to go. It looks like it's bottoming out. So I would start looking, maybe not chopping, but I would start looking at some expensive or good relative strength energy stocks. Matter of fact, let's take a quick look. Energy now, look at that. The last spot under a 1 month and cumulatively, it's also on the last spot right now. So energy, you got to be really, really careful on energies. If we look at the top stock right now, let's see where we could find an energy stock in here. So far, nothing. No, nothing yet. Nope. Looks like energy really did take a dump. It's kind of odd because most of the stocks are still looking good. Quanta, that's a utility stock, but that's a good one right there. Let's take a look. Maybe, Marathon Petroleum. There it is. So Marathon is still the strongest energy stock. So I would say, and look at that, it's bottoming out right here near support. And I would say when it comes down to this level, it probably won't be going down that much beyond this level. So be really cautious, but it may be time to start getting a little greedy on the energy sector. Now, today is Wednesday, and on Wednesday, I give you one long and one short. So let's go to our high list, and let me do that for you right now. If I was to pick the strongest stock right now based on everything I'm seeing, I'm telling you, I like Pulte Groups, I like General Electric, and I like ACGL, GE, and Pulte Group. They look great right now. And those are not energy stocks. And to the downside, oh boy, downside. Let's see here. So much to choose from right now. This CTLT looks like it's going to be going down to 50. And Tesla looks like it's going to be going down to about 152. Honestly, the worst one right now, in my opinion, the nastiest is Western Digital. I would sell this right now. It's near 32. I think it's going to go down to about 31, break 31. But WDC would be the worst stock right now. The worst stock right now in Wall Street. AMD earnings were bad. WDC deals with storage, still same computer space, not looking all that great. I generally recommend we sell this short, WDC to the sell side. And as I mentioned, to the upside, I gave you several stocks, including General Electric, Pulte Group, and ACGL. These look fantastic right now. The gambling stocks don't look too bad either, but I really like I like the industrial, the home builders, and this Arch Capital Group. It looks really, really juicy right now. Now, folks, keep in mind, we are going to have a major, major announcement today. Keep your eye on the market. The fact that we broke off yesterday, this level, leads me to believe we're going to be going a little bit lower or just staying choppy for the next few days. Don't have huge exposure, especially to financial or interest rate sensitive stocks, and that includes utilities over the next couple of days. Be really, really careful and stick to the strongest and the weakest stocks and forget about all that junk in between and expect a lot of choppiness. Now, before I let you go, folks, we're in the thick of earnings season. Dozens of companies reporting just about every day. There's a lot to go through, and which is why tech entrepreneur Mika Lammer's new strategy, you don't want to miss this. Mika discovered a brand new way to target outsized profit cycles within shares of Apple. It has all to do with waiting for a few specific indicators to align. He's going live today at 1 p.m. Eastern Time to reveal all this, and click the link below and get a seat for this. This is going to be a big, big reveal. He's going to show you how to target these profit cycles, and he's going to be using Apple to demonstrate. He's a professional Apple trader, and guess what? Apple is reporting tomorrow. You don't want to miss this. It's very timely, it's very sensitive, and it's a big, big reveal. Follow the link below, and I'll see you guys later. Remember, like the video, go to YouTube Wealth Press channel, like this video, subscribe to this channel, and post comments, and I'll respond for you. Bye, guys. Have a great, great day ahead.